Welcome to Eager Space. There are many people who dream of building companies to do interesting and useful things in space, but many of them run into a serious problem. Even if you have the best idea ever and can create a great team, you aren't going to get very far without money. Your first option to get money is self-funding. You might use your savings, you might dip into your home equity, and you might use money in your retirement funds. You can also ask for money from your family and friends, assuming you like karaoke. This approach has been a successful strategy for years. Hewlett-Packard started in a garage, the Apple I had very humble beginnings, and Gates and Allen used a PDP-10 at Harvard to write their first software program. None of those required a huge investment of cash. In space, you can take a similar approach with CubeSats, though you're talking roughly $100,000 to get something into space. Less if you can convince somebody like NASA to launch it for you. And that doesn't cover building or testing the thing. If you're wanting to deploy a real system, the costs are generally in millions, and not a small number of millions. When you move to launch, even small rockets are going to cost you many millions. Rocket Lab said less than $100 million for their Electron rocket and pad complex, but you can bet that it's not a lot less. And a fully reusable rocket like Stoke Space's Nova is going to be using the B word when it comes to funding. If you need more money, and in aerospace, you pretty much always need more money, you're going to need to mortgage your future. You chop off some percentage of ownership in a company and send that to the investor, in return for money that the investor sends you. There are a few ways to do this. You might find an angel investor, someone who will invest enough to get your company up and running. Some of Rocket Lab's early investment came from Mark Stevens, a man who was so into space that he changed his name to Mark Rocket. There's this guy named Elon Musk who funded a rocket named Falcon 1 out of the money he got when PayPal was acquired by eBay in 2002. There are also angel investor funds, where investors pool their funds to make small investments in new ideas. These groups may also provide mentorship. They do tend to invest small amounts, anywhere from $20,000 to about $1 million. That makes them a poor fit for anything but the beginning stages of a space company, as the amounts just aren't big enough. And at this point, venture capital comes riding in on a horse to save the day. The venture capital model is pretty simple. Find an interesting investment, estimate what it might be worth a few years down the road, trade 15 to 25% of that amount for a similar ownership share of the company, and then manage the investment. The last part is pretty important because VC funds want more than equity. VCs typically get seats on the board of directors, which means you no longer control your business or make all the day-to-day decisions. Their management generally has extreme growth pressure. They are looking for some sort of exit in a 3 to 7 year window, and they're okay if that exit is dissolving the company or getting it acquired by some other company. When that happens, if the company is dissolved, acquired, or goes public, they generally get preferential treatment. They get paid first. And finally, founders have to spend a lot of time doing what the venture capital funds want them to do and keeping them updated. Time that they can't spend running their business. To summarize, venture capital only cares about making money. They do not care about your space dreams. Most of their investments fail. They're expecting you to fail. Venture capital investment in space follows broader trends. The success of SpaceX generated a lot of interest in space, and a lot of funds were created, and VC investment therefore went way up. If there's a lot of interest, you may find it easy to get investment. If there isn't, you may find it nearly impossible. Which brings us to option 4, going public. Going public, having your stock traded on a major stock exchange, has a lot of advantages. You get easier access to capital, you don't have to deal with outside investors telling you what to do, and you control the timelines for the company. It also allows employees to convert equity to cash, and that can be a very welcome reward for years of work. The other investment options we already discussed all fall under Regulation D, which is part of the Securities and Exchange Commission rules that allow some companies to sell unregistered products. To buy these products, you need to be an accredited investor, which means you need to have a net worth of $1 million excluding your house, or have had a large income for the last 2 years. That limits the pool of people who might invest in your company to those who are, supposedly, better equipped to understand the risks and deal with the consequences, but it also keeps certain investments limited to a specific class of people. All this goes away when you go public. Anybody can set up a brokerage account and buy your stock. There are, however, big barriers to going public. You need to provide 3 years of historical, audited financials. You need to file detailed registration statements that detail business operations, management structure, and risk factors. You need to set up an independent board of directors, an audit committee, and strict financial controls. And you need to be big enough to get listed on whatever exchange you want, usually NASDAQ for space companies. These make a conventional initial public offering, or IPO, a non-starter for most space companies. A traditional IPO is managed and coordinated by an investment bank. The investment bank does valuation, organizes presentations where the company markets stock to institutional investors, and figures out the final IPO price per share. They also handle the actual transaction, buying shares from the company and then selling those shares to the investors. For this service, an investment bank typically charges 7 to 12% for a $100 million IPO. Investment banks love IPOs. Like the venture capital firms, they are guaranteed to make money on the deal. If you're unable to go the usual IPO route, there is an alternative invented back in the 1980s known as a Special Purpose Acquisition Company, or a SPAC. It's a way to sidestep many of the normal IPO regulations. A SPAC company is created and some initial investors put money into it. It then goes public using the usual IPO process, which is very simple because the company doesn't actually do anything. It has no products and no revenue. It's a shell company that just holds money. During this IPO process, investors buy stock in the company. That gives the SPAC a lot of capital. The SPAC company then dates other companies looking for funding in search of a compatible match. Let's look at an example. Vector Acquisition Corp was created and did an IPO, resulting in them being listed as VACQ on the NASDAQ stock exchange. They ended up identifying Rocket Lab as a target that met their criteria. The SPAC chose Rocket Lab among other opportunities, and Rocket Lab chose this particular SPAC because they believed it was the best deal for them. This is the same dance that happens between VC funds and private companies. The company was valued at $4.8 billion, and Rocket Lab gained $777 million in cash as part of the transaction. They then execute what is called a de-SPAC merger, where Rocket Lab takes over the SPAC corporate structure, renames the stock to something better, and is now a public company. Rocket Lab used that money not only towards Neutron, but to acquire a number of other companies. They acquired Planetary Systems Corporation, a manufacturer of separation systems and satellite dispensers in 2021. They acquired satellite solar power company Sol Aero in 2022. They acquired electro-optical and infrared sensing company GOST in 2025. They acquired laser communications company Mynaric in 2026. They acquired custom high-precision optical and mechanical instrument systems optical support in 2026. And they acquired robotic arm company Motif Space Systems in 2026. That was on top of the acquisition of spacecraft hardware manufacturer Sinclair Interplanetary in 2020 before they went public. And they just announced they are acquiring the existing satellite constellation company Iridium. Going public with a SPAC provided Rocket Lab with enough capital to diversify from a company that was mostly about launch into one that can build full spacecraft and already has a constellation. My personal opinion is that this was a very savvy move on their part. I do note that I have a small investment in Rocket Lab stock. My general impression was that Rocket Lab was an exception and that most of the space SPAC companies had not done very well. But it turns out I was a bit pessimistic. There are about 5 successful SPAC space companies. And there have been some other companies that went SPAC and didn't do as well as they'd hoped. It's been roughly 50-50 for the companies I looked at, which is a pretty good result for startups. My personal investment requirement is that I understand the business that companies are in and where they expect to be successful. And that's especially true for SPACs because there is less regulatory oversight, and the companies have a lot less of a track record than companies that go through the normal IPO process. Here's a quick chart showing both IPO and SPAC for space companies. You can see that there really aren't that many IPOs. The big spike in SPAC comes at the same time that big spike in VC investment in space companies showed up. Like VC investments, the SPAC route only happens when there is an investment team interested in your company, and that happens when there is overall interest in your sector. You can't do SPAC unless there is that interest. And that concludes the guide to financing your space company. Today's song is Dreamer by Supertramp off their 1974 album, Crime of the Century.